Hey guys, welcome back to another video. In today's video, I have a stock analysis here for a company called Toll Brothers. And Toll Brothers is essentially the nation's leading builder of luxury homes. So if I scroll down here, we can get a better look at some of their products, as we can see right here. And so basically in this video, I'm just going to look through the company's financial statements to get a better understanding of the company's financial health and their year-over-year growth for the third quarter of their fiscal year. And then I'm going to use a discounted cash flow model to figure out the intrinsic value per share of Toll Brothers stock, so we can know if at the current share price they present a good buying opportunity from a value investing perspective. And so we can actually see that over the last year, Toll Brothers is down 22% in the same year that the S&P 500 is down 17%. So they are underperforming the market at the moment. The S&P 500 is up about 40% over the last 5 years, and Toll Brothers is only up about 3%. But that being said, they have recovered quite a bit from their lows in March of 2020, and they've increased since then. But according to the analysis I'm about to show you, they may not have increased as much as they potentially should have based on the growth in their financial statements. So we can see right here in the balance sheet here for their third quarter fiscal year reporting results, they're comparing their results for their balance sheet from July 31st to October 31st, 2022 to 2021. And we can see the increase in their total assets was about $200 million, from about $11.5 billion to $11.7 billion. Most of that is held in inventory, about $9.4 billion of inventory. And most of their business is financed by liabilities as opposed to equity. So they have about $6.2 billion of liabilities, which is obviously going to increase their interest payments, and so that's obviously going to eat into their cash flows long term, unless they make larger principal payments to reduce their liabilities. And we can also see that their total equity increased as a result of an increase in retained earnings, which is a good sign because it shows that the company's equity is growing as a result of earned capital as opposed to contributed capital from outside investors, which would have diluted previous shareholders. So that's always a good thing to see. And so right here in their income statement, we can see that their home sales for the 3 months ended July 31st, 2022 compared to July 31st, 2021 have increased from about $2.23 billion to about $2.25 billion. So they did experience an increase in revenue for their home sales, but after delving in a little bit deeper in their financial statements and doing a little bit more research, I discovered that Toll Brothers actually reported a decrease in the number of homes that they sold. They actually delivered about 7% less homes in the third quarter of 2022 compared to 2021. So that only came out to about 2,414 homes, which means that this increase in their home sales revenue came from an increase in sales price as opposed to an increase in sales volume, which might have been, a lot of that might have come from the fact that over the last year, the housing market has been a little bit crazy and a lot of homes have been appreciating in value pretty substantially as a result of the housing market boom that recently happened. So that might have contributed to an increase in the revenue for Toll Brothers, which might also contribute to the fact that, according to some of the models and valuation models that different investors are using right now, Toll Brothers could be trading below their intrinsic value right now. And so we can see their total revenue came out to be about 2.4 to 2.5 billion, and they had about $1.9 billion worth of gross profit. So that comes out to be about a 76% gross profit margin, which is actually down from the 77.4% gross profit margin they experienced in the third quarter of 2021. And then right here for their net income, we can see they experienced net income of about $273 million. That was a net profit margin of about 10.96%, which is up from their net profit margin of about 10.4% year over year. And then also, if I scroll down a little bit more here, their earnings per share came out to be about $2.35 per diluted share, which is up from only about $1.87 per share year over year. And so if I go to page number 9, we can see their cash flow statement right here. They're comparing their 9 months ended July 31st, 2022 to 2021. And we can see that they actually experienced a net cash outflow for the 3 months ended in 2022 of about $246 million, which is down from a net cash inflow of about $448 million in the 9 months ended July 31st, 2021. And that came primarily as a result of an increase in purchased inventory, which could be a good sign for Toll Brothers, because obviously if they're purchasing more inventory, then they're anticipating higher demand for their products, which might result in an increase in their income later on past this reporting period here. And if I scroll down here, we can see that from their financing activities, as we saw earlier on their balance sheet, they had a lot of total liabilities, more liabilities than they did equity. And I pointed out that if they want to decrease their interest payments, which are eating into their cash flow, they're going to want to make larger principal payments to reduce their loan balance. And we can see right here on their cash flow statement that they did exactly that. They made principal payments on their loans payable, coming out to about $3 billion, which is up from $2.3 billion year over year. So they are making efforts to reduce their loan balance. And then on top of that, we can see that they're returning a ton of value back to their shareholders in the way of purchase of treasury stock and dividends paid out to their shareholders, amounting to about $66.9 million and $383 million worth of treasury stock that was purchased. So a ton of value returned to their shareholders. And I know it doesn't really say it here, but they also repurchased about 2 million shares worth of their common stock, totaling out to about $91.6 million. And so that ends up getting added to their treasury stock account. So a ton of value being returned to their shareholders. And in the long run, that's obviously going to increase the share price for their company stock, because there are going to be less shares outstanding, but the market capitalization is going to continue to increase as long as their retained earnings and their income is increasing as well. And so now what I want to do is I want to do a discounted cash flow analysis using this discounted cash flow model I have right here to figure out the intrinsic value per share of Toll Brothers. So I got some of these estimates from Yahoo Finance, and basically analysts from Yahoo Finance are estimating that Toll Brothers is going to grow at about 3.5% year over year for the next 5 years, compounded annually. And so for the next 5 years after that, I was conservative and I cut that value in half. They have about $1.24 billion worth of free cash flow reported for 2021. If I net their cash against their debt on their balance sheet, they have about $3.12 billion worth of debt, and they have about 113 million shares outstanding. So taking these metrics into account, we get their projected future free cash flow amounts at a growth rate of these growth rates right here. And we discount those values back at a 10% discount rate, which is the minimum return we would want for this investment. When we add these values together, we get the present value of the future cash flows, and then we subtract the amount of debt currently sitting on their balance sheet. That gives us the intrinsic value of the entire company in billions. So the entire company is estimated to be worth about $11.32 billion. And if we divide that by 113 million shares outstanding, we get $99 per share with a 30% margin of safety of $69 per share and a 50% margin of safety of $49 per share. So ideally, if we wanted a 10% return per year with these growth rates in mind, we would want to buy into the company at a share price at minimum of about 99, or at maximum of about $99 per share. And if we weren't too certain about our analysis and we thought maybe there was room for error and we could be wrong, then a 30% margin of safety would be this price, and a 50% margin of safety would be about $49 per share. And if we compare that to the current share price of Toll Brothers, we can see that they're trading at $44 per share. So they are trading below a 50% margin of safety right now, putting them at a pretty deep discount if these estimates are to be believed. And to be honest, a growth rate year over year of only 3% is really not that crazy of an assumption to make for a company. That being said, obviously over the last few years, or over the last year or so, the housing market has been pretty crazy. So it'll be interesting to see if the housing market can continue to produce results the way it has in the last year or so. Because if it can't, then that's obviously going to alter some of the metrics for the valuation of Toll Brothers moving forward. But on the right side here, I also did a competitor analysis just to figure out where Toll Brothers ranks up against other companies in their industry. So I compared them to D.R. Horton and KB Home. And we can see that from a ratio analysis perspective, just looking at the company's business efficiency compared against each other, we can see that Toll Brothers is about middle of the pack in terms of gross profit margin. They have about 22% gross profit margin compared to D.R. Horton's 26% and KB Home's 21%. For net profit margin, it looks like Toll Brothers is actually bottom of the pack, and on return on assets, it looks like Toll Brothers is bottom of the pack as well. So from a ratio analysis perspective, it would appear that D.R. Horton would be the best investment, but I actually went ahead and did an intrinsic value analysis for D.R. Horton off camera before this video, and it turns out that their company is not trading below intrinsic value per share. So even though their business efficiency might look a little bit more attractive from a competitor's standpoint, according to some of the estimates from Yahoo Finance, D.R. Horton is not trading below intrinsic value per share the same way Toll Brothers is. So from that perspective, even though it might look like D.R. Horton was a better investment, from the intrinsic value perspective, it looks like Toll Brothers might actually present the better buying opportunity at the moment. But that being said, obviously, if we're going to judge them based on their historical performance, their stock price hasn't been that impressive. It's only returned about 3% in the same period that the overall market has returned about 42%. So I'm interested to see what happens with Toll Brothers. Obviously, according to this analysis, they're trading at a very steep buying opportunity right now, trading below a 50% margin of safety. So I'm not really sure what to think about Toll Brothers. Let me know in the comment section down below what you guys think about this stock and this company. Is it a good buying opportunity right now or not? Definitely let me know what your opinion is. I'd love to talk about it. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.